All right, welcome. This is another episode of the Know Your Numbers podcast with your host, Chris McCormick. Today, a very special guest in the name of Ryan Bakke. Ryan's a CPA, running his own shop with a couple employees, prepping and planning for taxes year round. Ryan, welcome to the show, man. We were catching up a little bit before the show, but give the audience a little background on who you are and what you do.
Yeah, so my name is Ryan, and I own and operate a 100% virtual CPA firm focused on real estate investors. We help people who own real estate tax plan as well as strategize around investment decisions. I started off, I have two bachelor's degrees, one in accounting, one in finance. I didn't find a love of real estate until I was actually working at a small CPA shop while in college. I had prepared a tax return for a married couple that made about $200,000. They were both W-2 employees. And then I prepared a tax return by a single guy who had $400,000 in real estate cash flow. And the guy who was single, making double the amount of money that the married couple did, he paid less in taxes than the married couple did that made half the amount of income. And I remember asking my boss at the time, who was another CPA, and I say, now, how is that possible? What's going on? And his simple response was, it's because he invested in real estate. Right. And ever since that moment, it was kind of like a shining light. And I've spent the last however many years figuring out exactly how to do that. And what you'll learn and what everybody should take away from it is earned income is taxed the highest. So if you have to show up to work, whether that's your day job with self-employment, your own business, earned income is taxed the highest. It's passive income and portfolio income, the other two types of income that are taxed the least, if not at all. Right. And the name of the game becomes, how quickly can you shift your earned income to passive income or portfolio income? Because you're going to increase your cash flow while also lowering your effective tax rate at the same time.
Yeah, man, that's awesome. And I think that's a great place to start, because we do have a lot of real estate investors as well as aspiring real estate investors. And one thing that I think gets talked about but doesn't get talked about enough is the tax advantage. So when you speak passive income, that confuses a lot of people. Some people think, oh, real estate's the way to go because it's all passive, and then they come to find out that it's mostly active and there's a lot of work involved. So I'd love for you to talk about some of the tax strategies that you look for to make it, at least on paper, passive income and less taxable in the eyes of the law.
You bring up a good point, because a lot of people get passive income confused. They think if let's say I make an ebook and I sell it for $15, that's passive income. Yeah. It's not actually. It's self-employment income. Actually, it's taxed the worst that it can be, because you're going to have ordinary income tax, the same as if you were to work a job, and you're going to have that additional self-employment tax. Yep. True passive income comes in the form of two things. Number one, by default, all rental real estate is passive. Yep. So whether you own single family, multifamily, condos, apartments, short-term rentals, commercial buildings, that's all passive income by default. The other activity that's passive income is any activity in which you do not materially participate in. So for example, my friend owns a hair salon. I want to invest in her hair salon. I'm a passive investor in that business. I give her cash. I don't make any management decisions. I don't have any say in the business. She runs the business on the day-to-day. I don't materially participate. So that's a passive activity to me. Yep. Those are the two forms of true passive activities. Now, why do we want passive activities? Is because number one, they're not subject to FICA tax. So FICA tax is Social Security and Medicare. If you're a W-2 employee, go look at your pay stub. There'll be a line item for Social Security, and there'll be a line item for Medicare. You do not pay this tax when you have passive income. So immediately, any money you have coming in from a passive income source is automatically taxed 8%, about 8% less, because you're not subject to that FICA. Furthermore, passive income can be offset by a host of exclusions, such as any sort of expense that you have for that property, or depreciation is the one that we like to talk about the most. But the passive activities will net each other all day long. So if I have let's say for example, if I have a loss coming from my rental property that I own, so I own a duplex right now, a multifamily house, and I have income coming from, say, my friend's hair salon, those two activities, because they're both passive activities, they'll net each other. So I could essentially pay nothing in taxes on any of that income.
Yep. Wow, cool. That's good, man. Yeah, no, it really is cool. And that's something that I try to articulate to the listeners is that the tax code is really kind of a puzzle in a way, and that there are incentives for you to, one, make money, but two, also keep that money and find ways to keep it in legal but strategic processes. And one of those, which you touched upon, is depreciation. For somebody that has been in the industry for a little while now, like yourself, and has had experience with depreciation, what has been the biggest benefit, and what are some of the ways that you go about introducing this topic to a client who might know about it, might not, but are definitely leaving something on the table with the depreciation?
Yeah, so Albert Einstein said that compound interest is the eighth wonder of the world. I really think depreciation is the eighth wonder of the world, because it's a phantom expense that you do not have to come out of pocket for, but it goes against your income that you're able to take an expense for and ultimately pay less in taxes. And so to kind of give you an example is, let's say the building that I purchased, I'm not going to get into all the calculations, but just know that you cannot depreciate land. You can only depreciate the amount of the building. But let's say I get about $10,000 of depreciation every single year. Well, my particular duplex, I might rent out for $12,000 a year. If I have $10,000 of depreciation, I have $12,000 of cash flow coming from that duplex, but I get to turn around and tell the IRS I only made $2,000. And that's the power of depreciation. And to give you an idea of what the tax savings are on depreciation, you can multiply the amount of depreciation by your top marginal tax rate, and that's the amount that you're saving. So for me, I'm in a 24% federal income tax bracket with a 5% state tax rate. So I'm in a 29% tax bracket. If I have $10,000 of depreciation, I'm saving $2,900 a year in taxes because of depreciation.
Wow, that's awesome, man. So what state are you located in?
Illinois.
Illinois. Okay. And is that where you're investing as well?
Yeah, my properties are in Illinois, unfortunately.
Yeah.
We do have really high property tax bills here. Yeah. I'm looking out of state to invest in some tax-free states, places with mountains or beaches. Those are the two kind of primary locations I'm looking at for like short-term rentals, specifically. And just because there's better tax benefits in short-term rentals, they cash flow better. I'd rather be like a host rather than a landlord also too. It kind of has this weird connotation with being a landlord. Yeah.
No, I'd love to talk a little bit more about that, because that's something that's I think not on top of everybody's mind, but honestly should be. I mean, short-term rentals are coming up more and more, but I don't think some people understand the incredible tax benefits that are, like the Augusta rule and certain other rules where you can rent it out for a short amount of time, and if it's in that right time period, you might not pay any taxes. So I'd love to hear your take on that, and what you look for in a short-term rental, and some of the things that you try to do to maximize your tax benefits.
Yeah, so the first thing with short-term rentals is the location. So you're going to want to have a good location that's going to have high occupancy. There's going to be demand. There's fly-in markets, there's drive-in markets. You have to know your sort of clientele. So for example, the Smoky Mountains is a drive-in market. A lot of people will drive to that particular location. You have to also know the makeup of the building, especially when it comes to depreciation. So for example, condos, townhomes, those normally don't have any sort of land allocation to them, which means you'll get more in depreciation by buying something like that, as opposed to buying a property in, say, California, where there's a lot of land valuation out there. I've seen properties 30 or 40% land valuation, as opposed to say 15 or 18% over here. And particularly in the Smoky Mountains, they're even lower. Sometimes there's 6 to 8% land allocation, which means you get a ton of building basis for depreciation. One thing that sticks out about short-term rentals, and you have to understand how those passive activity loss limitations work. So generally speaking, passive activity losses can only be used to offset passive activity gains, which prevents your doctor or lawyer person from using their rental losses to offset their W-2 income. Just think about it. Like if I'm a rich doctor and I make $1 million, I can go dump my money in real estate, accelerate the depreciation, and use the loss to offset my income. Congress plugged that in 1986 when they overhauled the tax code. And that's when they separated it between non-passive and passive. It was until 1993 when they came out with real estate professional status, which basically said, if you want to take a passive loss against your non-passive income, you have to be a real estate professional, which it requires a ton of time. You have to spend at least 750 hours in real estate per year. So automatically, if you're, a nurse, doctor, lawyer, CPA, you're not going to qualify because there's not enough hours in the year for you to actually be able to be involved in the real estate. Now, the exception to that, however, is short-term rentals. So short-term rentals, I could pull up the subsection. I have it somewhere on my computer. There's a subsection in the Internal Revenue Code where it says that if the average guest, average user of the property stays at least 7 days or less, it's not a rental activity. It's under Section 469, which means then that short-term rental, you don't have to be a real estate professional in order to qualify to take the short-term rental loss against your non-passive income. You still have to do what's called material participation, which I'm not going to go into on this call, but it creates these huge tax benefits for people who are, high earners. We're talking probably 24 or 32% federal tax brackets who buy short-term rentals and manage the short-term rentals themselves. They do all the decorating and the staging. They screen the guests. They do all the management. They're able to use the short-term rental losses against their W-2 income. And on average, I would say a 32% tax bracket person buying a $500,000 cabin, they're saving anywhere between $30,000 to $40,000 a year in taxes. Yeah. And it's really crazy because another thing that's favorable about short-term rentals is that you can qualify for some pretty cool financing. So they offer what's called a 10% down secondary home loan. So you can buy a $500,000 cabin with 50 grand down. Yeah. And if you're getting $40,000 of tax savings on the back end, it's almost like the government's subsidizing 90%, 80% of your first short-term rental. It's awesome.
Wow. No, it's so good, man. And you articulate it so well too, because oftentimes people hear conversations between guys like you and myself, and they're like, okay, I have no idea what they're going to be talking about. But you, you simplify it, and I want to say dumb it down, which is amazing, and it's good. So I'm learning as you talk, and it's awesome, man. I'd love to hear your take on a take that I usually have, and that's the fact that I like to think that every CPA should own a business or have their own book of business. And I honestly like to think that almost everybody should have their own business in general because of the way the tax code incentivizes it. If not business, then real estate investments. But what have you learned in your business ownership career? And what are your recommendations for any CPA or non-CPA looking to get started and needs a good incentive to get going?
This is across the board. Figure out what you're in the top 10% in the world in, whether that's whatever it is your craft is. You like computers, you like technology, arts and crafts, hair cutting, being an accountant, engineer, lawyer. Figure out whatever it is that you're in the top 10 percentile at and do that. Master that craft, because that's what's going to allow you to excel in your career, no matter what you end up doing. Even if you decide not to open up your own shop, what's gonna help you excel. Being a jack of all trades, or kind of being able to do everything, works well sometimes, but you're never going to be that sort of expert that people can rely on as a subject matter expert. You're just kind of going to be a jack of all trades. So I encourage people to find now passion doesn't always correlate to work. So some people find passion outside of work. I would highly recommend you to find a balance of both. So if you can find something that you can do for work that's also your passion, that's great. If not, use the time outside of work to work towards your passion.
I like that. And I've also heard it stated, like, don't necessarily find your passion, bring your passion with you as you do it. Because Ryan, I think you can agree that accounting, tax isn't always the most exciting part of life. And but the fact that somebody like you can be passionate about it and bring it with them is what makes them different and sets them apart and puts them in that 10% section. So man, it's cool to see. And dude, for somebody that's so young and not to limit you at all, it is encouraging. And I'd like to think back, because offline we were talking, you started at 17 preparing taxes and getting into the accounting world. Was it from that point on where you kind of knew that you were going to be doing something on your own? And did it come sooner or later than you would have expected?
So honestly, at 17, I really 17, 18, when I first started, I really didn't even know what I wanted to do.
Yeah.
In high school senior year, I actually almost failed on a math class. I had a D- in my senior year calculus class.
Love it.
And just didn't really know. But see, with accounting, I was always good at math, but not the stuff that they taught in school. I was always good at mental math and percentages and figuring things out. I fell in love with it because it kind of combined a little bit of both. It combines knowing math, knowing how to do something well, but then also a little bit of legal aspect to tax, of having to navigate the tax code. And the mesh of those really, really sat well with me. And I almost remember it as when I was first starting in school, I was learning accounting, I was learning finance, but at the same time in other classes, I was learning how to use Excel. And it wasn't until I combined Excel, time value of money, projecting out retirement income, projecting out all these things, that I was like, this really clicks for me. And this is something I want to spend a good chunk of my time doing.
Wow, that's awesome. And that's kind of, I think that's a lot of people find in accounting. I mean, there are obviously those people that stick with accounting. It's all the numbers crunching, and they're good at it. And I honor that. And I think people are meant to do that. But a lot of accountants and people that I went to school with know and discuss with in the industry kind of like that overlap of the logical law, the rules, paired with the numbers and the calculations, and being able to do it quickly and say this is what it will provide for you. So it's cool to hear you articulate that, man. And I want to honor your time here and don't want to take up too much of it. I know you got some stuff going on behind the scenes, but I would love to hear what you have planned for the future of your business. I know you do more than just tax prep and accounting and bookkeeping. You do kind of have that servant heart, and you're looking to help people through consulting as well. So in however much time you desire, what's next for Ryan Bakke and his firm and his entrepreneurial path?
Yeah, so we're working on something right now called, I dubbed it the financial freedom calculator. So it's figuring out how much of your own money do you need to have invested within real estate in order to achieve a desired outcome. So if, say, $50,000 of my own money can buy me $200,000 worth of real estate, and $200,000 of real estate at X% return can provide me this much cash flow. I'm working on creating a financial freedom calculator so people can actually see something on paper or on Excel and start working towards that goal. And it's really helping people. What I say is, and it's Stephen Covey's second habit of the 7 habits of highly effective people: begin with the end in mind. So if people can see just how their outcome in their life can be by investing, that's what I want to help people achieve. And this is not just real estate specific, but I also encourage people to invest in Roth IRA accounts, retirement accounts. And even for people that are young, just a small amount of money per month can add up so much. Yep. And that's sort of what my consulting and the future videos that I publish will be geared towards, is helping everyone understand, regardless of their walk of life, that financial freedom is achievable for everybody.
Yeah. Wow, that's awesome, man. And I look forward to sending that out. Do you have an expected release date, or is it kind of in the works and we'll know more sooner?
It's in the works. I have like some back of the napkin calculations on Excel, but I'm really trying to get it like modeled out and put in. So to just drop you something. So if you're 25 years old, you only need to invest $155 a month at a 10% interest rate for 40 years in order to have $1 million. Wow. So 25 to 65, you only have to do 155 a month to be a millionaire at 65. So now what's cool about numbers is numbers work no matter where you're at. You can be in California, Illinois, New York. Math makes sense all across the 50 United States, right? And say you wanted $3 million. So now you have to multiply the 155 by 3. You need to be doing, what is that? $455 a month to be at 3 million. But what's interesting about time value of money is the sooner you start, the more you're going to have. And that same calculation, if you were to wait until you're 35, you actually have to invest 3 times the amount of money per month to achieve the same outcome. So if I invest at 25 versus 35, that's a 3x difference. So if I don't start until I'm 35 and I still want to be a millionaire when I'm age 65, I have to invest $450 a month at age 35 in order to achieve millionaire status, when I could have just started when I was 25. The bulk of the problem comes with how America has sort of codified the money talk. Money is not supposed to be talked about. It's kind of taboo. And especially with student loans and car debt, you see a lot of people go into massive amounts of debt, and money is just never talked about. I really want it to be not as taboo as it is. But I think if younger people can start realizing, hey, I really shouldn't buy a $50,000, $60,000 car when I just graduated college, or, take out these amount of loans. I mean, I've heard of people going to colleges just because they like the houses that were in the area, or go to out of state to go into debt to achieve the same degree.
Right. Yeah, man. And that's, I think that's something that more people need to talk about. And I don't think money needs to be this foreign object, but we have kind of made it that. And part of it is because it runs a lot of our lives. And that's what I'm looking to do, is kind of change the conversation. Ryan, I know you have a bit of a faith background. We didn't even get to dive into that, but maybe we can save that conversation for another day. I do like to close every episode with the same question. It does have to deal with money. And Ryan, it goes a little bit like this. It's, what is one truth about money that most people regard as myth?
Money changes people.
Yeah.
Okay. It doesn't. Money doesn't change people. It just amplifies what's already there.
Wow.
So if you are a giver and kind at heart, when you don't really have too much money, you're going to be even more fruitful and more giving when you do come across money. If you're a Scrooge and you're not a giver, and that you're going to be the same way when you amplify it, when money gets amplified. If you're rude, if you're mean, more money is just going to amplify what's already there. It's not going to change the type of person.
Wow. That's incredible, man. And I love how quickly you were able to articulate and answer that, man. And you are articulative, and that's something that I appreciate about you. I'm so glad I got you on the show. If people want to follow you, find you, reach out to you for all their real estate tax needs, where can they do so?
Yeah, so we're on Instagram and Twitter at Learn Like a CPA. That's at Learn Like a CPA. Oh, I'm also on TikTok now. I just published my second TikTok. Okay. So all 3 platforms at Learn Like a CPA. We have a Facebook group called Tax Strategies for Real Estate Investors. There's about 2,000 members in there now, and that's where you can find and get in touch.
Wow, awesome, Ryan. Well, thank you for your time, man. I'll keep you posted on when we can release this, but I know we'll be in touch sooner rather than later. So
thank you so much.
Man.